reduced the benefit to try to trim that liability down, just like in private sector. And some are not in a position to put aside very much money. Portsmouth has spent time in the past to reduce this benefit, so they brought that liability down a lot.
So,
okay.
Landon, this is Brian. I think it's just to follow on what Patty was talking about, very good fiscal policy to fund this thing because it is ultimately a liability to the city. Specifically to your question, there are a lot of plans around the country, particularly at the state level, that are pay as you go and that are unfunded. And I would say the majority, I don't have the exact numbers in front of me, but the majority of these types of plans, particularly at the state level, are unfunded.
Well, the states, and just we could talk all day on this, Brian. States budget, they budget on a cash basis. So if they're running into a problem, they just push it into the next year, and where local governments have to show it.
Yeah.
If you owe the money.
Yeah.
Virginia is notorious, just like all the other states. Yeah.
Okay. If we don't have any questions about the OPEB account, I think it's on to the Greystone report.
Great. Well, good morning, everyone. And I apologize, Patty, my computer's having the same problem that yours did earlier, apparently. So,
must be catching, yeah.
You don't see me from what I understand, but hopefully you can hear me. And looks like Tom's got the our presentation up. I'm just going to cover real quick a review of first quarter capital markets. I'm going to turn it over to Jim to talk about our outlook, and then I'll pick it back up again to review the portfolio. I'll, of course, give an update for the month of April as well. And Patty, I'm not sure if the individual's name who you didn't recognize is Darren Belofsky, but he's part of our OCIO group with Greystone and Morgan Stanley. So he's on to listen and to see if there's any questions that are raised that he be in a better position to answer. But obviously Jim and I are very well attuned to what's going on in the portfolio here. So maybe if you can just go to the first slide that has a bunch of returns there. Skip that one. Perfect. Here we go. So here's a quick snapshot on the left-hand side of the return of the major capital markets. There's a shaded column in blue that's representative of the first quarter of the year. And then just to the left of that is the month of April. It's actually, I think when we ran this, it's not the full month of April. It was ran as of April 28th. So when we have final numbers, it'll be slightly different than what these are. But a couple of things jump out to me. In the first quarter of the year, there was a lot of focus around rising interest rates. There was a lot of focus around potential for higher levels of inflation in the future than we've experienced in the recent past. We'll talk about why those concerns sort of percolated into the market, but nonetheless, those were the two major issues that were going on in the market. All that said, equity markets were still quite strong during the first quarter. You can see the first row there, the S&P 500 index up over 6%, 6.2%. And that rally continued in the month of April, where we were up over 3%. So when we look through April, we're going to be up in large cap U.S. equities to the tune of 11, 12%. So certainly a continued rally in U.S. equity markets off of the lows that we experienced in March of last year. We know why we were there. And with all the stimulus and programs and impact that the Fed and Congress has had, we were able to recover quite sharply. and that sharp recovery has been sustained so far into 2021. A couple of other things to point out on the U.S. equity side. During the quarter, this is kind of halfway down the table here, the Russell 2000 Index, small cap stocks did better than large cap stocks. We were up about almost 13% in the quarter for small cap stocks, about twice the return of what large cap stock returns were. And then when we look at this notion of growth stocks versus value stocks, if you go sort of back up in that table to the Russell 1000 Index and look right under that, you'll see a value stock return, you'll see a growth stock return. Value stocks have been really strong off of the lows that we experienced again about this time last year, up 11% in the quarter versus 1% roughly for growth stocks. So from a U.S. stock perspective, you know, quite strong results. If you go down to the sort of the bottom, maybe third of this table here, we show the returns of various non-U.S. equity markets. The Msci Efa Index there is a developed market index, so continental Europe, Japan, Australia, countries like that. We're up 3.5% in the quarter, up 3%, another 3% in April. And then the second to the bottom row in this table here, emerging markets, up about 2% in the quarter, about 2.5% in April, puts us up for about 5% for the year so far through April. So from a global equity perspective, all markets were positive, all segments of the market were positive, but a clear advantage, at least in the quarter, to U.S. equities and in particular small cap stocks. If you move over to the right-hand side of this page here, where we look at the individual sectors, and this is just of the U.S. equity markets, you can see that, and this sort of relates to the relative performance of value stocks over growth stocks in the quarter and even, you know, over the past year or so. It's the sectors of the economy that have lagged for such a long period of time, really coming out of the global financial crisis, that are really doing well right now. What I mean by that, it's the energy stocks, it's financial stocks, those kinds of companies whose multiples and valuations were quite cheap and quite below what the broader market was, that have really been driving the broader market's return. And it's the stocks that had done so well coming out of the global financial crisis, technology companies, consumer discretionary stocks, that were the laggards in the first quarter. So when Jim talks about, you know, outlook, Eggy's going to talk about this rotation that we're seeing in the market, maybe away from those high growth, high multiple technology and consumer discretionary stocks, and more towards, to use a sort of a phrase that was popular back in the late 90s, in some sense, these old economy stocks, right? It's the energy companies, it's the industrial and material companies, sectors of the economy that are much more leveraged to underlying economic growth. We'll talk about what the potential implications of that are, but the leadership in the market has changed. Still good returns for the broad market and broad index, which is what effectively we own, but it's the kinds of stocks that underlie that are maybe a little bit different this time than this time last year. If you can move ahead to the next slide, I'll just provide a couple of comments on the bond market, and then I'll turn it over to Jim. You can see the results here were pretty negative. The Barclays Capital U.S. aggregate was down about 3.4, almost 3.5% in the first quarter. This was the 100-year flood, quite frankly, in the bond markets. It's the worst bond market we've seen in 40 years. And we saw interest rates on the 10-year Treasury back up, increase by almost 1%, about 80, 82, 83 basis points. again, what was driving that was, I think, a couple of things. Number one is the realization, I think, of the market and now consensus view that the economic recovery that we were going to experience coming off of the pandemic lows is going to be real, and it's going to be quite robust. So there's a realization that growth from the U.S. economy is going to be a lot stronger here in 2021 and into 22 than I think people were thinking originally. Secondly, with all of the stimulus, both from a fiscal policy perspective as well as the Fed on the monetary side, with all the stimulus that's been injected into the system, there are now concerns around a potential pickup of inflation. So those two factors combined, stronger growth, potentially higher levels of inflation, led to a pretty significant increase in interest rates, which of course results in negative bond returns. One other thing I'll point out on this slide, just go down maybe to sort of 2/3 in this table. There's something there called the Barclays U.S. Corporate High Yield Index. High yield bonds, which are lower quality. Oh, sorry, Tom, a little bit higher than that. The U.S. Corporate High Yield Index. We were up those types of bonds were up about 1%, 0.8% in the quarter. And then up another 1% in April. So we've got a healthy allocation to high yield bonds in our fixed income portfolio that we'll talk about. So that exposure helped to soften some of the blow that came through from rising interest rates and investment grade bonds. So with that, I'm going to stop, turn it over to Jim, unless anybody has any specific questions about capital markets or the economy order.
Have you covered the balance at, you say this is as of, I guess, the end of April, or what point in time?
So we show a couple of different time periods there, Patty. Most of the comments will be around data ending March 31st.
Okay, thank you.
Great. Thanks, Brian. It's wonderful to be here with all of you this morning. Tom, Stanley, I've got to say that you're probably the most dynamic screen sharer that I've worked with. I love the real-time adjustments and highlights that you make. Not that much has changed since we last spoke about the economy. We have been espousing this V-shaped recovery for quite some time. You've heard it last couple of quarters about this from us. Interestingly, however, I think it's all coming to sort of a crescendo here in the second quarter. We think U.S. nominal GDP growth could approach 10% for the quarter. These are levels we haven't seen since 1984. So really a white hot economy as it starts to fully reopen. And there's going to be some implications for this that I'll cover in a little bit more detail in a minute. So where are we spending our time? What are we focused on now? And what we're focused on now are peak rates of change, because at least in the short run, these peak rates of change can really matter and impact capital markets. It could potentially create investment opportunities for us. So what are we looking for? We're looking for a peak in fiscal policy, equity flows, the Fed balance of payments, earnings revisions. All these things can cause equity setbacks. So we're going to look at a few of these this morning, but this is really where we're focusing our time and energy. You know, we were early in the V-shaped recovery call. I think now it's become generally sort of consensus thinking. So we're trying to look forward what's not consensus, and looking for peak rates of change helps us understand that. We said this at our last meeting, that inflation is really key for the secular bull market. We had a bit of a surprise number yesterday, which I'll talk about. But the biggest risk for equities and other long duration assets, if you will, is really interest rates. So let's look at some of these points a little bit more closely. So if we can move to the next slide. You've seen this slide before. We've updated it, however, for the 1.9 trillion American Rescue Plan that was approved in March. I think the key takeaway from this slide is that we really haven't seen deficits like this since the end of World War II. Really incredible amount of stimulation, and these huge deficits are going to have consequences, some good, some not so good. It's going to impact, in our view, the length of the economic cycle, the velocity of the cycle, and also interest rates and inflation. We have said for quarters now that the reopening is going to happen, and it's going to be more powerful and happen faster than most investors expect. This is all happening with 1.9 trillion approved and two other programs being debated in Congress as we speak. And that's the $2.3 trillion infrastructure plan, the American Jobs Plan, and the $1.8 trillion American Families Plan. So those are going to be heavily negotiated over the coming months. Hopefully something gets passed by the end of the year, but that's $6 trillion of stimulus coming at a time where the economy is already starting to reopen, and you're seeing labor shortages. And let me put that in perspective for you. In April of 2020, unemployment peaked at around 14.8%. And that was the highest it's been since 1984. And certainly some of the really hard-hit areas like leisure, hospitality, that unemployment surged to north of 40%. But today, we're right around 6.1%. Last month's unemployment number was a little bit disappointing, but it's not going to be linear getting back to where we were. So we've come back from almost 15% to call it 6%. And we've got all this stimulus working its way through the system, and potentially trillions of dollars of more stimulus. So our view is that there's certainly pockets of the economy, certain pockets of consumers that need additional support and stimulus, no doubt about it. But all of this additional stimulus on an economy that's already starting to reopen and seeing commodity shortages and labor shortages is probably going to have some unintended consequences. So let's look at that for a minute. Move to the next slide. This next slide, just if you looked at it quickly, you might say, well, this is a cryptocurrency slide, just straight up price performance, but it's actually just M2 money growth. And what we're looking at here is this growth in the money supply is running at about 27%. So this is not a perfect indicator by any stretch, but if you look at the order of magnitude in the money supply growth versus history, it's just undeniable that it is breakout money growth. And a couple other things to keep in mind about this money growth. During the Great Financial Crisis, the money supply tended to get trapped at banks because their balance sheets were in such a disrepair, and it never made its way into the real economy. Today, what we see is this money supply growth is going direct to the consumer, and the consumer's balance sheet was in pretty good shape going into the pandemic, and the bank balance sheets were in pretty good shape going into the pandemic. So a lot of stimulus is going to have to work its way into the economy, and the way we think about this is it's a new paradigm, and the new paradigm is going to be unknown to some extent, but in our view, it's fairly clear that if you look at the prior slide, you look at this money growth slide, that the new paradigm is going to be probably surprisingly high inflation, at least in the short run. Let's move to the next slide. There's a lot of information here on this slide. But if you remember from your econ class, this is just a basic supply demand curve. And I think it's very, very timely, just given the inflation numbers that we saw yesterday about what's really happening in the underlying economy. Couple things that we think are going to be learned here as a result of this information. Number one is it's going to be very apparent that it's much, much more difficult to turn an economy on than it is to turn an economy off. And you can think about that at a micro level if you think about a business and how easy it is to shut it off and how difficult it is to restart it. And that's, you can think about that for almost any business, including the human capital side of the reopening. We think it also is starting to become apparent that during an economic lockdown, some of the supply is either temporarily turned off. Timber mills, as an example, basically shut down during the pandemic and now starting to reopen, and reopening very slowly. And as a result of all that, we see record high timber prices because some of that supply was actually destroyed. If we look at this chart for a second, and we look at the left axis, that's price, and the bottom is quantity, we see a shift from point A to point B. This is just an economy that's reopening, it's fiscal stimulus leading to increased demand. So it gets us to point B. And then if we look from point B shifting to point C, this is because, as I was saying, the pandemic has inhibited supply and created some constraints. So less supply is going to result in price increases. And this is exactly what's starting to unfold in the economy today. We're already starting to see some serious supply constraint concerns, semiconductors. I'm sure you've all read about this first quarter on earnings conference calls, the reference to supply chain constraints or pressure and inflation. Just those words on these conference calls has tripled compared to what it was the past decade. So we're seeing, as I mentioned, timber prices, home prices, used car prices that are at a record high. We've seen companies such as Procter & Gamble, Coke, and Pepsi tell us that they're going to be raising prices. So all of the data that we look at indicates to us that we're going to start to see some pretty significant price increases. The question, of course, is it permanent or transitory? We'll cover that in just a minute. This next chart is pretty straightforward. This is just shows the spread between the consumer price index and the producer price index. The PPI, or the producer price index, is wholesale inflation. It's what companies are paying for goods and services. The CPI is the price that it sells it at, or the price that consumers buy it at. So it's just the spread. So all you can see here is that the PPI right now is exceeding the CPI by quite a bit. As a matter of fact, it's fairly extreme. You got to go back to 2008, 2010 period to see this type of margin pressure. So this will result in margin pressure at corporations because they won't be able to pass all of it along, but eventually it will flow through to the consumer, the CPI. And yesterday we saw a number at 4.2%, which was multiples higher than what was expected by economists. So starting to work its way not only from the wholesale level, but to the consumer level as well. It was really that inflation number that sparked yesterday's sell-off. In keeping with the spirit of peak rates of change, what are we looking for? This next slide is looking for a topping out of earnings revisions. And as you can see, it's earnings revisions coming out of the pandemic have been up and up and up with this recovering economy. So revisions have been very, very strong. But eventually they peak and they roll over. we think that we're probably getting close to a peak or rolling over of increasing earnings estimates. This doesn't mean that we're forecasting a recession by any stretch, but it's just another peak rate of change. And when you get these peaks, the investors have to start discounting new information. And where will the peak roll over to? Is it temporary? Is it something more permanent? So that's what creates all this choppiness in the financial markets, because it's been pretty much straight up since the bottom in March of last year. Another area that we're a little concerned about, we're watching closely, is margin debt growth. So this slide shows the growth in margin debt since 1988, and it's quite significant. So the shaded yellow portion here is the year-over-year dollar amount of change in margin accounts. So this is investors borrowing money to invest in financial assets. In dollar-based terms only, we've never seen a change this large. So this change represents about $250 billion of year-over-year increase in margin. And the blue line is year-over-year percentage change in the S&P, and that tends to track relatively pretty nicely to the change in margin. So our view here is that these margin change balances are probably close to peaking, if haven't peaked already, and again likely to roll over, if not a collapse in stock prices or the market, but something else to watch, because if the margin debt starts to roll over, it's pretty likely that the S&P could experience a rollover as well. This last slide is, I think it's pretty interesting to look at, taking a giant step back and look at something that Brian was talking about earlier, old economy stocks, new economy stocks, technology stocks, value, growth. This just looks at it in a slightly different lens, and it looks at high quality stocks versus low quality stocks. High quality stocks being companies that are generating profits consistently, less variability in earnings, and less debt on the balance sheet. Of course, low quality would be quite the opposite of that. So what we're looking at here is, you can see that early in the cycle recovery from the 2008-2009 financial crisis, low quality stocks did really well coming out of that crisis. And if you think about it, you would expect that to happen. These are companies low quality because they're perhaps have negative earnings, have a lot of debt, and if the recession continues to linger, the outlook for these low quality companies isn't very good. But as soon as the outlook starts to improve, it's like a breath of fresh air. These low quality stocks start to rally pretty hard, and that's what happened in the 2008-2009 period. And then mid-cycle, after that, we started to see quality stocks start to outperform low quality stocks. And then if we drag this analysis forward to the pandemic, it's very similar story coming out of the pandemic. Low quality stocks dramatically outperformed for some of the same reasons, and high quality stocks eventually start to recover. And that's kind of where we think we are in this mid-cycle. So all of this means for us is we wouldn't be surprised to see a mid-cycle correction of some magnitude, 10-15%. We'd actually welcome it. We think it takes a little bit of the frothiness out of the capital markets and creates a little bit better risk profile dynamic going forward. And it could be any one of these or other peaks in rates of change that I talked about this morning that could be that trigger. So I'll stop here unless there are any questions about our views on the economy, and I could turn it over to Brian to go through the portfolio in some detail.
Great.
Thanks. Thanks, Tom.
Tom, if you can go to slide 18 real quick. Perfect. So here's a quick snapshot of where we are in terms of our broad asset allocation as of the end of March. The middle column in this table here shows our actual weight at March 31st. Column to the left-hand side is what our targets are, what is our benchmark allocation. A couple of things jump out. We're running at about a 75% equity orientation, which is slightly higher than the 70% target. Now, that's been a good place to be. As we talked about, when I talked earlier, this being the worst bond market in 40 years, and equity markets continuing to do well in the first 4 months of the year. So that overweight to equities, and in particular, U.S. equities, and within U.S. equities, small caps, been a good place to be. We'll show you I think in the next slide or a couple of slides, some attribution from that. But from a portfolio positioning perspective, been really good for how the capital markets have played out in the early part of this year. There's a corresponding underweight to fixed income. We're at about 19% fixed income, whereas we're supposed to be about 22%, so slight underweight there. And then within fixed income, as I mentioned earlier, some exposure to high yield bonds, which is not in our benchmark. And then from a duration perspective, given this outlook that we've talked about, our view that for a while now that interest rates are heading higher, we have a shorter duration profile in the fixed income portfolio relative to the benchmark. So those two factors, shorter duration, overweight credit, and in particular high yield, helped us generate some returns during the quarter. On the bottom of this table, the alternative side is, this group knows we have a little bit of real estate. We have a little bit of some hedge funds there. We're underweight there by the tune of about 2%, 6% versus 8%. Alternative investments are not something that you can manage the application on a day-to-day basis of. And so as opportunities become available, we would expect our exposure there to get closer to the benchmark. But all in all, our portfolios are certainly within the range as specified in the investment policy statement, slightly overweight equities, but generally in line with what our targets are. Can you go to the next slide? Here's a snapshot of performance. On the first column is the first quarter result. At the bottom of the table, you'll see the OCIO return. This is our return, 2.65%. This is net of all fees. And our benchmark, which is 70% equities, 22% bonds, and some alternatives, was up 2.77%. So we underperformed in round numbers by about 10 basis points. And you'll recall that I talked about our portfolio positioning being quite good for how, for what played out in the capital markets, offsetting the positive impacts of that, and we'll look at this on the next slide, with some underperformance from some of our active managers. But we show on the right-hand side the longer-term returns here. Obviously, 2020 was a really strong result. We were up, over 2% that year. We were up about 2% in 2019. Since inception, since we've had discretion, which is now, what is that? 2.5, almost 3 years. On a fully net of fee basis, we're outperforming our benchmark by about 1.7 percentage points. So really good results over the long run, in line over sort of the short run, the first quarter of 2021. If we looked at April, and I talked about earlier, equity markets continued to be strong. We actually got interest rates settled down a bit during April, and now they're kind of back up again in the early part of May here. But We estimate our return for April to be about 3.5%, and the benchmark's return to be about 3.3, 3.4%. So when we take into account April, we outperformed probably by the magnitude of the underperformance in the first quarter. So through April, our portfolio is right in line with the benchmark. Any questions on performance before I get to attribution and then talk about managers? Okay. Tom, can you go to the next slide, please? Thanks. So here's a look at our attribution. So, and I'll kind of walk you through this. On the far left-hand side, our benchmark's return was 2.77%. That was the return of the benchmark. If we did nothing but invest our assets at the target weights and earn the broad market returns in the individual asset classes, we would have earned a return of 2.77%. So I talked about earlier, we were overweight equities, and in particular U.S. equities, and even at a more granular level, small cap. Well, I'll set that issue aside. We were overweight equities, underweight bonds, underweight alternatives. The impact of that, because equities outperform bonds, was to add about another 22 basis points. That's that broad allocation effect. So our portfolio positioning in the broad asset categories, overweight stocks, underweight bonds, added almost 0.25% during the first quarter. This sub-allocation effect looks within the broad asset category. So as I mentioned, we were overweight U.S. equities, but in particular, we were overweight small and mid-cap stocks. And then within the fixed income market, we were overweight credit, we were short duration, we had high yield bonds. Those factors, those asset class portfolio composition decisions added about another 10 basis points. So those portfolio positioning and portfolio construction concepts added in aggregate about 0.33%, 32 basis points. Now that was offset by the underperformance of a number of active managers in the portfolio. We'll talk more specifically about that. That's what the selection effect is. It detracted 42 basis points. I'll just say that most of our active managers underperformed. And there are a couple of reasons why most of our active managers underperformed. Number one, if we have a bias in the type of managers that we like and that we invest with the idea of them generating strong levels of return over a full market cycle, is that we tend to favor those managers that have a quality bias. Now, what does that mean? It means most of the holdings in their portfolio are those high quality stocks that Jim talked about, ones that have strong brands, low levels of debt on the balance sheet, stable levels of earnings, good, earnings growth. And as we talked about, it's the other kinds of companies that have done particularly well. So that was a big factor across the entire portfolio of the active managers that drove some of that underperformance. Now, when you look at over the long run, I don't think anybody wants to invest in, for the long run, low quality, junky kinds of companies. But the reality is you can get discrete periods of time, like we're sort of in the midst of, which we think is turning, where these lower quality names, companies with no earnings, companies that have high levels of debt on the balance sheet, companies that have very difficult time weathering a downturn in the economy, where those names outperform over shorter periods of time. So you add up all those numbers, you go from the benchmark's return at 2.77%, some good stuff, some stuff didn't work out, we get to our 2.68% return. So again, 10 basis points of underperformance, we sort of recouped that in the month of April. Through April, we're sort of right in line with the benchmark. Any questions about that before? I'm just going to show you a couple of the managers. I'm not going to go into a great detail. As you know, we have discretion where if we, become concerned about a manager, we'll certainly swap them out and add something new in there. But any questions about this, portfolio construction and attribution or returns at the total portfolio level? Okay. Tom, if you can go to slide 32. And this is the last slide I'm going to touch on. We show here, and I apologize, it's not easy to see what manager we're talking about, unfortunately. But I'll just call your attention. But here we show all of the managers that we have in the portfolio, and it goes on to the next slide as well. The things I want to point out, that first, I don't know, about a third of the way down the slide here under emerging markets, Artisan Developing World Fund. This is a manager we've had in place for a long period of time. Manager we really like, and it's a manager that you'll see in the first quarter that struggled. They were down 2.5% versus their benchmark of 2.3%. So they underperformed by almost 5%. I will tell you, and this is a manager, again, that we've had for a long period of time. They underperformed in the first quarter, but keep in mind they were up 83% in 2020. I forget exactly what the benchmark's return was, but I think they outperformed by about 50 percentage points, somewhere in that range in 2020. So looking at short periods of time obviously can lead to misleading results. The long-term track record here of this manager since we've had them in place in the discretionary program, up over 32%, double the index's return. When this manager goes through periods of underperformance like it's had, and it's recovered half of the underperformance in April, they tend to reposition the portfolio to really focus on those names in the portfolio that have gotten hit, but that they have the most confidence over the long run. And that's what we expect to see from this manager in this environment here. We expect, hopefully a resumption of the strong results that we've enjoyed over the long run. Next couple of managers are some large cap U.S. equity managers. First one, Poland's a large cap growth manager. They did well during the quarter, outperforming. Aristotle is our large cap value manager. They were up 10%. Their index was up 11.3%. So underperformed, but certainly a very strong result. Anytime you see or we see markets rally as strongly as they did, and in this case, large cap value stocks up 11% in a quarter, what you tend to see is active managers underperforming in those environments. And the reason for that is because they hold a little bit of frictional cash in their portfolio. So even if you only hold 2 or 3%, the market is up, over 10% in a quarter, that has an impact. Now, that's not all of it, but the trend of active managers underperforming in a rapidly rising market is something that we've observed for a very long period of time. The next one, I'm not exactly sure what that number is because I saw it this last night. This is Rice Hall James, this is one of our small cap managers. And first of all, I saw there wasn't a benchmark there, and then I was scratching my head and I said, there's no way that manager was down 5.5%. So I think that number is wrong, actually. So they were up 4.3% in the quarter, and their benchmark's return was 2.5%. So I apologize for that. We'll look into it to see kind of what was driving that. But this is a manager we've talked about in the past, right? They've underperformed over the long run, but they were able to generate some nice results in the first quarter. I'm not going to go through the other managers here, but you'll see we go into the developed market international managers. We look at fixed income markets managers, but by and large, if I were just to kind of summarize, results are in line with the benchmark. We've had some stuff that has worked out in terms of our portfolio positioning. We've had some short-term underperformance from a number of the active managers in our book, and we know why that is, given what's going on in the market. But I'd say we're pretty happy, pretty satisfied with as strong of a year we had in 2020 to be able to continue to perform in line with the benchmark. I think is a good result. We feel good about where we are, our portfolio positioning. And with that, I'll just stop and see if anybody has any questions.
I'm good. Thanks, Brian.
Great.
Jim.
Thank you.
Thanks, Landon.
Okay, I can give a quick update here. Again, just generally provide some material for the board to be aware of, not necessarily to dive too deep into the detail of the ongoing administration and services that we're providing to the Portsmouth retirees. So just to jump ahead, so in general, you know, this is really what's guided what we do year over year is these 7 goals and initiatives, and you know, these are the items that I will continue to bring back to the board and provide updates on. Today, just want to highlight real quickly product offering update. Again, you know, as I've talked about in the past, with this being a pension system, a frozen pension system, and a limited number of actives, you know, a lot of the enhancements don't directly apply to the group, but I just, you know, hope that awareness to the continued investment into what we're bringing to, you know, participants in general is important for you all to be aware of. And then just we'll touch on a couple of the high-level plan metrics, and then, you know, the quarterly expense and revenue disclosure that we'd like to share. So from a participant experience, you know, again, we're continuing to invest in available services and resources for individuals. There are a number of things we're focused on this year, and many of these actually have already been introduced. You know, the one really just to highlight, and again, probably limited use in this type of retirement program, but we did just fully enhance and update our mobile app. Pension benefit information is available through it. Again, most people being in pay, they probably don't really have a need for it, but we have brought a lot of the experience in the full online site into the mobile experience, primarily for defined contribution and 401k relationships and customers, so that, you know, they really can start to see what their long-term income replacement is. And then just, you know, some additional enhancements we've made for tools being available. You know, for some individuals, they may be looking for resources for things like data aggregation, budgeting assistance. We do offer tools like that. We partner with Yodelay to bring a pretty involved personal finance organizer that's available through the website. So if for some reason questions ever come up or people are looking for a resource, they do have that opportunity through the retirement program. And then more to the plan sponsors, so to the city and the finance department and the HR and benefits group, you know, we continue to try to look to enhance system and capabilities. You know, just a couple of things to point out to the board. We do have, you know, a very involved and continuously updated public site, retirement.johnhancock.com. We did just release our 2021 State of the Participant. You know, it's a pretty involved study we do every year, just looking at, especially last year, the challenges of the pandemic and how that may have impacted individuals from a long-term savings perspective. And then there's just a lot of other viewpoints and information that's available out on that site. So the link is in the presentation. If anyone has interest in taking a look at it, you can just click right through that link. We also offer ongoing legislative webinar series. So we do quarterly webinar updates from, ERISA regulatory updates on things that are happening. There was some pension legislation that was included in this year's stimulus. It didn't really impact municipality governmental plans, and again, didn't really impact you all since of the status of your program. But we do continuously look to give updates and insights on those types of things as well. And that information can be found, again, out on the public site if you wanted to access and take a look at it. Right. So from a plan perspective, I know Brian showed some of this, but the end of Q1 closed very strong at over 242 million in assets. Still over 1,000 participants, but continuously declining, and we'll look at some of those numbers in just a second. Obviously, Brian and Jim get into all the details from an investment holding, and just as a reminder, the vast majority of assets for the system are now held externally at Morgan Stanley. So Darren, who's on this call, we work closely with and his team on an ongoing basis to make sure that we have appropriate cash on hand to pay ongoing benefits and expenses, and we coordinate with our trust group to move money and make it available as needed. So a couple of system statistics to look at. So the fire and police, if you look over here all the way to the right-hand side, still holding at 10 active participants. I did take a quick look just out of interest. So 5 years ago, Q1 2016, there were 32 actives at that point and 722 total beneficiaries in the plan. So, again, with the frozen nature of the system, we are going to continue to see the decline, and that's all worked into the ongoing actuarial projections and liability needs. From a cash flow perspective, no significant changes here. Number of monthly benefit payments did dip under 1,900 for the first time. So, just a slight continuation of the reduced activity in the program. And then those 10 actives that are left in the plan, they're all over 25 years of service. So we know, especially in the fire police side, that those retirements will be coming soon. All right, and then taking a quick look at supplemental. So here we have 12 actives, 362 in total. Not as much change here. So 5 years ago, there were 17 actives, but there were 410 total individuals that were receiving benefits or were set up to receive benefits. So that's about a 12% decrease. Similar comments here on cash flow. And then also here, you see significant number, 11 individuals, 25 plus years. So, again, we know these individuals will be most likely retiring or moving on soon. All right, and then finally, as a reminder, this is a quarterly disclosure that we give just so that there's overall awareness for cost and the expense, and now there's no longer any revenue sharing. But if we look left to right here in the grid, we break this out by the two systems and then in total. So first off is investment management fees. So this is the cost of all the individual investment managers, doing what they need to do to manage those funds. That's at 37.2 basis points. We then break out Greystone's cost, John Hancock's cost. In the past, if you recall, there were an investment or two that provided some additional revenue sharing back to the program. Those have now been removed just based on investment allocation changes, which just makes this a little cleaner. So there's no additional revenue coming back in. And that leaves total expense, just under 54 basis points to run the program.
Tom, is this an annual number?
Yeah, so this is annual and it's projected, Patty. So what this actually does is, and if I'm not sure how easy this is to see, but this looks at assets as of March 31st, and then it projects out what assumed cost would be. So it's more of a forward-looking projection.
You know, when we do that that funded status reconciliation, I'd like to be able to break those out going forward. I don't know if Andre can do that.
Yeah, so I did. So Andre was actually out of the office this week, but I did connect with him briefly. We do have the ability to do that. It's just, you know, again, whether or not, I know there was some discussion as to if this is a report that goes to council and or is public, you know, does the group want to field questions about that? But we certainly can do it.
I can talk to Andre. I'd like to break out John Hancock and Greystone. And on terms of the investment management costs, I think we can footnote that somewhere. I mean, we can talk about that offline, but this particular table that you're showing now, when we showed City Council, it got a couple council members very confused, and it got some of the police and fire, the retirees, confused. So I'm just looking for a way to kind of remove some or all of that confusion.
Yeah, no, understood. And
I
again,
understand.
I know this was definitely geared towards the board and you all.
Yeah.
Yeah, but yeah, that's fine. We can regroup when Andre gets back and figure out the right adjustment.
Yeah, we'll just talk about it. I understand it perfectly what you're doing, but I'm telling you what, you know.
No, but I get it. I understand.
All right, thank you.
Yep. So that's all I have from my standpoint. If there are any questions, any other questions, happy to take them.
Tom, I did have a technical question and I do apologize profusely. But with the confusion between Mimi and I not joining the meeting right away, I think that the first 15 minutes of this meeting was not recorded unless you recorded it. And yeah, I don't think you did.
No.
Yeah. So, Mr. Challenger, what do you think we ought to do? We lost the roll call and the minutes and that kind of thing, but we've got everything from OPEB forward, I believe.
I'm not sure what can be done other than just to state that the roll call was done and that there was a quorum. I believe there were 4 members present and
yes.
three members that were not present. So I think that's
yeah.
the significant part of the earlier part of the meeting that was not covered. So we have a.
Okay. All right. Well, Mr. Moore, Mr. Gardner, Mr. Holly, and Mr. Munson were present, as was Mr. Challenger. And are there any other ones? Is Demetria right on? I see her initials down there.
She is on.
Yes, I'm here. And Mimi is, of course, on, as am I. Okay, I think that will do it, Mr. Challenger. I think we covered ourselves.
Yes, I think we're good.
Okay, thank you very much. Well, Landon, I put a note as our next meeting date is August 12th, because that would be the second Thursday of that quarter. And if that's okay with everyone.
Should be fine with me.
Okay. Well, I turn it to you then, Landon.
I think that covers everything on the agenda, unless anybody else had any other questions or comments they wanted to add before we adjourn.
Landon, one quick comment. I checked last week. We have 6 members on the board. that we have one vacancy that still remains. And I found out the reason why is we haven't had an applicant. So we're still looking for an applicant for the retirement board. So right now we only have 6 members.
Okay. Well, you know, I don't know how we find potential members, but I can sort of think about it if I know anyone.
That'd be great.
Very good.
Okay. Well, thanks everyone. Appreciate all the updates. Good to see all the board members and everyone. And I think we can adjourn.
Very
You
good.
will.
Thank you.
Thanks, everybody.
Thanks, everybody.
Take care.
Tom, great work today. Thank you.
Take care.
Bye.